There will be no quick video editing or flashy edits here, only useful practical information. And remember, the last point that we will consider is the most important. Enjoy the video. Fixed rate or adjustable rate mortgage, which one is actually better for your financial future? Most home buyers choose one without fully understanding the long-term consequences. That decision could potentially cost or save you tens of thousands of dollars over the life of your loan. In this video, we're breaking down the key differences between fixed rate and adjustable rate mortgages in a simple, practical way. Make sure you watch until the end, because we'll reveal the type of borrower who benefits the most from each option, and the answer may surprise you. Let's start with the fixed rate mortgage. A fixed rate mortgage means your interest rate stays the same for the entire loan term. Whether you choose a 15-year or 30-year mortgage, your principal and interest payment remains predictable. If rates rise dramatically in the future, your payment doesn't change. That's one reason fixed-rate mortgages are the most popular choice in the United States. Homeowners love stability. They know exactly what they'll be paying next month, next year, and even 10 years from now. That predictability makes budgeting much easier. However, there is a trade-off. Fixed-rate mortgages often start with a higher interest rate compared to adjustable-rate mortgages. That means your monthly payment may be higher at the beginning. Now let's look at adjustable-rate mortgages, often called ARMs. An ARM starts with a fixed interest rate for a specific introductory period. Common examples include 5/1, 7/1, and 10/1 ARMs. The first number represents how many years the rate stays fixed. After that period ends, the interest rate can adjust based on market conditions. This is where things get interesting. During the introductory period, ARMs usually offer lower rates than fixed mortgages. Lower rates can mean lower monthly payments. Lower payments can improve affordability and purchasing power. In some cases, buyers may qualify for a more expensive home. But there is an important catch. Once the adjustment period begins, your interest rate can move higher. If rates increase significantly, your monthly payment could rise as well. That's the risk many borrowers underestimate. So does that mean fixed-rate mortgages are always the better option? Not necessarily. The right choice depends heavily on your personal situation. For example, imagine you plan to stay in a home for only 5 years. In that scenario, a 5/1 ARM could potentially save you money. You might sell the property before the adjustable period even begins. As a result, you could benefit from the lower initial rate without experiencing future adjustments. On the other hand, if you plan to stay in the home for 15, 20, or 30 years, the equation changes. Long-term homeowners often value payment stability more than short-term savings. In that case, a fixed-rate mortgage may provide greater peace of mind. Another factor to consider is the interest rate environment. When rates are historically low, locking in a fixed rate can be extremely attractive. Many homeowners refinance specifically to secure long-term stability. However, when rates are unusually high, some buyers consider ARMs as a temporary strategy. They hope rates will fall in the future and allow them to refinance. Of course, there are no guarantees. Future interest rates are impossible to predict with certainty. That's why relying on refinancing alone can be risky. Here's a simple rule many financial professionals use. If you prioritize predictability, fixed-rate mortgages are usually the safer choice. If you expect to move relatively soon and can tolerate some risk, an ARM may be worth considering. But never focus only on the initial monthly payment. Always evaluate the worst-case scenario as well. Ask yourself how comfortable you would be if rates increased substantially. The answer to that question often reveals which mortgage fits your situation best. So which mortgage wins? The truth is that neither option is universally better. Fixed-rate mortgages offer security and stability. Adjustable-rate mortgages offer flexibility and potentially lower initial costs. The smartest choice is the one that aligns with your timeline, risk tolerance, and financial goals. Before making any mortgage decision, run the numbers carefully and consider multiple scenarios. A few minutes of planning today could save you thousands of dollars in the future. If you found this helpful, make sure to subscribe for more practical personal finance and real estate insights. And let us know in the comments, would you choose a fixed-rate mortgage or an adjustable-rate mortgage, and why?